Every month, I make my top stocks that are looking cheap videos. And this month, I want to do the same video, but for the Canadian markets. The reason is because, well, I am a Canadian, and I have been finding a lot of value in the Canadian stock market. So in today's video, we are going to discuss 5 Canadian stocks that I think are looking cheap in the month of July. Before we get into the 5 stocks though, I want to let you all know that this video is sponsored by Moomoo. Moomoo is a brokerage app that is trusted by over 21 million users globally. And recently, Moomoo expanded into Canada. The Moomoo app has a lot of unique and value-added offerings, such as an economic calendar that offers push notifications about macro events going on in Canada. This helps you stay up to date on all the most important news coming out. Moomoo also supports pre- and post-market trading in Canada, which allows you to buy Canadian stocks from 8 a.m. to 5 p.m. Eastern. Additionally, Moomoo has some of the most cost-effective trades in Canada. They offer $2 trades and a 0.09% currency exchange rate on US stocks, which makes them the most affordable brokerage when converting currency and buying stocks in the US markets, as you can see in this table. You also get access to a lot of free tools, such as institutional portfolio tracking, analyst ratings, dividend payout calendars, financials, and more. Moomoo is offering a few different welcome bonuses, such as a $50 cash coupon on a $100 deposit, which is like a 50% return. The welcome bonus also increases as you deposit more money, all the way up to $1,200 in cash coupons. And don't worry, your money is secure, as Moomoo is a member of the CIPF, which protects investments up to $1 million. So if you're interested in checking out Moomoo, then click the link in my description to learn more. My link gives you $1,888 in commission-free trades as an additional bonus. Now with that being said, let's hop into it. Alright, so the first stock that I want to talk about in today's video is Equitable Bank, or EQB.TO. This has crept its way up to become one of my largest personal holdings. And for those of you who may not know, Equitable Bank is basically the fintech bank of Canada that is disrupting the Canadian banking industry. Equitable Bank also recently reported its earnings, and I have some slides to show you how the bank is currently doing. So right here we can see that its adjusted return on equity was 15.9%. Adjusted diluted earnings per share was also $2.81, up 2% quarter over quarter and up 7% year over year. Revenue came in at $317 million, up 6% quarter over quarter and up 20% year over year. So right away, the earnings results actually look pretty dang strong. Again, revenue was up 20% and EPS was up 7%. And this is some of the best results in the entire Canadian banking industry right now. Adjusted net income came in at $111 million, up 2% quarter over quarter and up 9% year over year. Total AUM is up 18% year over year. EQ Bank customer growth is up 7% quarter over quarter and 36% year over year. And EQ Bank's customer growth is one of the number one metrics that I focus on because it tells us how many customers the bank is actually gaining and overall how customers are receiving the bank's promotions and etc. And 36% year over year growth is pretty insane. Book value per share is also up 14% year over year, and the common share dividend is up 22% year over year. So just take a look at these results. The bank is performing incredibly well, even when the other Canadian banks are kind of reporting slower growth or maybe even more loan losses, but overall, Equitable Bank is still growing very strongly year over year. Now moving on to the next screenshot, this one says decumulation lending assets, including reverse mortgages and insurance lending, increased by 10% quarter over quarter and 57% year over year to $1.7 billion. With growth accelerating as a result of successful consumer advertising that bolstered public awareness, strong broker services, and value to the borrower. So Equitable Bank's decumulation business is growing extremely well, and it's projected to continue growing at these growth rates for the remainder of 2024. Commercial banking loans under management also increased by $1.5 billion quarter over quarter, and insured multi-unit residential lending increased by 35% year over year. And for those of you who may not know, Equitable Bank is one of the number one banks that is funding all of the multi-unit residential building going on within Canada. If you are a Canadian, then you know that our government is really pushing to build more affordable housing, and Equitable Bank is one of the top banks that is helping all of the builders with the lending to get this done. Then Equitable Bank also says that only 1% of the bank's loan assets are associated with offices, and those balances declined in the quarter. So Equitable Bank does not have a lot of office loans or office real estate on its books, which I do see as a good thing. All right, now let's move on to Equitable Bank's cash flow statement. So right at the top here, we can see that reported net income came in at about $106 million. Then we can see that stock-based compensation was only 1.1 million, which means that stock-based compensation is less than 1% of the company's net income, which in my opinion is a very low amount of stock-based compensation. And Equitable Bank does have a history of doing very little stock-based compensation. And if you watch my channel, then you know that I do think that this is a great thing to see. We can also see down here that the dividends paid was only $16 million, which means that Equitable Bank's payout ratio is around 14 to 15% of net income. And this is partly why the bank is able to grow its dividend at 20% year over year. Because in addition to Equitable Bank growing its net income year over year, it's also only paying out a small amount of its net income as a dividend. So it will be able to continue growing the dividend even on the current net income. All right, now this next screenshot shows how Equitable Bank is performing year to date versus its 2024 guidance. So we can see that return on equity is currently sitting at 15.7%, which is above the 2024 guidance. Pre-provision pre-tax income is at 388 million, which is on track to meet guidance. Diluted earnings per share so far year to date has actually been muted at only $5.57, which is trending below 2024 guidance, but the management has reaffirmed that they are maintaining this guidance, and they do think that earnings will grow much more rapidly in the second half of the year. Dividend growth is in line with guidance. Book value per share is trending a little bit below guidance, but again, the company is expecting growth to pick up in the second half of the year. And then the CET1 ratio is above guidance currently. So really what I want to see for the remainder of the year is book value per share and diluted EPS accelerating and growing in line with guidance. Then they also show us how the loan book is trending towards guidance. So total loans under management is trending towards guidance. Single family residential lending is trending below guidance. Wealth decumulation is trending towards guidance. Commercial lending is trending below guidance. Multi-unit residential loans are trending above guidance. And EQ Bank customers are also trending within guidance. So in terms of EQ Bank's loan portfolio, it looks like it needs to kick up its commercial lending and its single family residential lending to meet the overall guidance. And again, the bank has said that it is confident that these numbers will pick up in the second half of the year. Now, this next screenshot actually came from Twitter, which shows the price to tangible book value versus the return on tangible common equity for all of the large major Canadian banks. However, this screenshot did not include Equitable Bank, so I took the liberty to go and do the calculations myself, and this red dot right here is where Equitable Bank sits on this graph. Now, what this graph also shows us is that as the return on tangible common equity, or basically the return on equity, increases for a bank, its price to tangible book value, or its multiple, also expands. Now, what's interesting is Equitable Bank has one of the highest return on equities, but its price to tangible book value is dramatically below this trend line. If Equitable Bank was actually trading in line with the other large Canadian banks and how they trade, then its price to tangible book value would be at 2 or above, or basically double what the bank is currently trading for. So I think that this chart right here really shows how much of a discount Equitable Bank is currently trading for relative to its peers and relative to the quality of the bank. So in my opinion, I do think that Equitable Bank is actually quite cheap in the market, and I think that it is arguable that Equitable Bank should actually trade for a premium to what the other Canadian banks are trading for. And the reason simply is because Equitable Bank is the fastest growing Canadian bank, and it also has one of the lowest loan loss provision rates, and it is also producing one of the highest return on equities. So basically, it's one of the highest quality, most fast growing banks in Canada, and it is trading at a significant discount to all of the other Canadian banks. And in my opinion, over time, this discount will be corrected, and I do think that this valuation gap will disappear over the long term. Now, if we head back over to Stock Unlock, we can also see that Equitable Bank is currently trading for about $89 a share. The company is also projecting to do $12 in earnings per share for the year of 2024, which means that the bank is selling for a forward price to earnings ratio of about 7.41 today. Now, if we take a look at Equitable Bank's 10-year average price to earnings ratio, we can see that it is about 7.7, which means that on a forward earnings basis, Equitable Bank is actually trading below its historical averages. And as a whole, a business trading for a 7 price to earnings ratio while growing revenue at 20% and earnings at 7% year over year, I think is just silly in the market. And this is why I think that Equitable Bank is such an undervalued stock. And to elaborate more on what I mean here, we can head over to Stock Unlock's discounted cash flow calculator. And I am saying that Equitable Bank will grow its earnings at 10% annually over the next 5 years, do no dilution, grow the dividend at 22%, and trade for a price to earnings ratio of 9, which is still, in my opinion, a low multiple for this bank. And if these metrics do come true, then the stock could deliver a 16.7 compounded annual return to its shareholders on the price today. And the fair value for the stock is about $120 per share with these estimates right here. Now, what's also worth noting is over the past 5 years, Equitable Bank has grown its earnings at an annual rate of 20%. So a 10% growth rate to earnings over the next 5 years is actually below the company's historical average growth rates, which ultimately means that, in my own opinion, these numbers right here are still kind of conservative for Equitable Bank. And if the company can actually meet or beat these projections, then it can also deliver returns above 17% annually. And again, this is one of the reasons why I think that EQB is so cheap, and it is one of the reasons why it is one of the largest stocks in my personal portfolios. So for all of those reasons, I do think that Equitable Bank is still looking cheap in the stock market, and that is why it is number 1 in this video. All right, moving on to the second stock that I want to talk about in this video is GoEasy with the ticker symbol GSY.TO. Now, GoEasy is a subprime lender in Canada with an insane track record. If we take a look at the company's historical returns right here over the past decade, we can see that the stock is up over 800% now and has massively outperformed the S&P 500. And I do believe that this stock can continue to outperform going forward. GoEasy also recently reported its second quarter earnings, so I'll point out some of the highlights from the earnings report. The company's loan originations were up 12% year over year, and its loan portfolio also grew 29% year over year. Revenue grew 24% year over year, and adjusted earnings per share grew 24% year over year as well, right in line with the revenue. So this business is growing its revenue and its earnings by 24% annually, still in the current market that we are in. We can also see that the increase in lending was driven by a record volume of applications for credit, which were up 41% over the prior year. So GoEasy is seeing a very strong demand for lending, and its lending applications are hitting all-time highs and growing insanely well year over year. During the quarter, the company also continued to experience stable credit and payment performance. The net charge-off rate was 9.1% at the midpoint of the company's forecasted range between 8.5% and 9.5%. So GoEasy's customers and its credit performance is still within its guidance and in line with the company's historical averages, which is a good thing to see. Now, continuing on, this is that operating income for the first quarter was a record $138 million, up 35% year over year. Operating margin for the first quarter was 38.6%, up 3.1% year over year. And adjusted operating income also grew 35% year over year. So GoEasy's operating income is also seeing strong growth year over year. Net income for the first quarter was $58.9 million, up 15% year over year, and after adjustments, net income was up 25% year over year. So again, GoEasy is absolutely killing it. And this is one of those businesses where every single time they report, I am kind of just blown away, and I am waiting for the day that GoEasy stops growing at 20% year over year. But so far, it has continued to maintain that growth rate, which is pretty incredible. Now moving on to their investor presentation for the second quarter. This says, record quarter for application volume at 613,000 people, up 41% year over year. 40,400 new customers, up 17% year over year. Net lending volume to new customers represented 69% of total credit advanced, up from 67% last year. So again, GoEasy is seeing a record amount of applications for loans, and they are seeing strong customer growth of 17% year over year. Now, in terms of auto financing, the company had a record quarterly originations exceeding $116 million, up 49% year over year. So GoEasy's auto financing business is growing incredibly well. Its point of sale financing business is also growing strong, growing retail, home, and healthcare verticals with originations up 20% year over year. They also added over 480 new merchants, and their point of sale financing offered through a record of 10,000 merchants now. Think about this as well. GoEasy added 480 new merchants on the quarter, and they have 10,000 total merchants. This means that their total merchants grew by about 5% in this quarter alone. Now, this next slide shows that their net charge-off rate is within their historical averages and within their guidance of 9.1%, and the loan loss provision rate is also in line with their historical averages of about 7.3 to 7.4%. So currently, GoEasy's net charge-off rate and loan loss provision rate are not red flags to me, and they are still within the company's historical averages. Now, this next slide simply just shows us how insane GoEasy's year-over-year growth is. Again, revenue up 24.3%, operating income up 34.9%, operating margin up 8.7%, operating income up 34%, And you can pause the video if you want and take a look at the rest of their metrics right here. So now let's take a look at GoEasy's guidance, and they are forecasting to achieve the high end of their loan book guide for 2024, which is $4.55 billion. The company is also expecting total revenue of about $1.55 billion for this year, and the total company operating margin is expected to be over 39% for the year as well. So they are expecting strong revenue growth, and they are expecting their operating margin to continue expanding for the remainder of the year. Then by 2026, they are expecting about $1.7 and $1.9 billion in revenue, and their operating margin to continue expanding to above 41%. This overall should lead to some pretty strong earnings growth because the overall revenue is projected to continue growing strong, and the margins are projected to continue expanding. And the result is earnings should grow quite significantly over the next 3 years. Now, if we take a look at GoEasy's price to earnings ratio today, it is currently sitting at about 12.4, and its 10-year historical average has been about 12.3. So the stock is trading right near its historical average price to earnings ratio, but I do still think that a 12 price to earnings ratio for a business that is growing its revenue and its earnings at 24% is pretty dang cheap. Like a 12 PE for 20% plus growth is not something that I see in the market too often. And if this was a tech company, this price to earnings ratio would be like 35 to 40 right now in this market. So I do believe that GoEasy is still looking attractive in the market, even though it is trading for its historical average price to earnings ratio, simply because its PE versus growth is very low in my opinion. Now, if we do a quick discounted cash flow calculation on GoEasy, and we take a look at its operating income and say that operating income will grow by 17% annually over the next 5 years, which is well below the company's historical average of 30% annual growth, and grow its dividend by 20% annually and trade for a 6 price to operating income, which is the company's 5-year historical average, then we get a compounded annual growth rate to the stock of 18.5% and a fair value of $271 or 45% above where the stock is currently trading. So if GoEasy can hit all of these metrics right here, which I do think the company can do, then the stock could continue to outperform the S&P 500 and deliver strong returns to its shareholders. And for these reasons, I put GoEasy as number 2 in this video, and it is a stock that I do think is still looking cheap in the market today. All right, now let's move on to the third stock that I want to talk about in this video, which is Brookfield Asset Management. The ticker symbol is BAM.TO. Now, I also have a little bit of a rule for myself and my own portfolio, and that's that whenever BAM's dividend yield gets back above 4%, I add to my position. And we can see here that the dividend yield on the stock is now just above 4%. So I have been buying these shares and adding to my position recently. Brookfield Asset Management is also the second largest position in my personal portfolios, and in this video, I will quickly explain why. But let's start off by talking about what BAM actually does. So Brookfield is one of the largest and fastest growing alternative asset managers in the world, distinguished by its 100+ year history of owning and operating real assets and businesses, and now it operates in over 30 countries around the world. The company also has $929 billion in assets under management, and it invests in the renewable power and transition, infrastructure, private equity, real estate, and credit and other industries. So these are the main areas of Brookfield's business and where it focuses its capital. Now, if we take a look here, we can also see the Brookfield ecosystem, and we can see that Brookfield is in the housing, hospitality, business services, infrastructure, transport, midstream, industrials, wind, science and innovation, technology services, healthcare, data, hydro, office, utilities, solar, logistics and self-storage, mixed-use retail and entertainment, and energy transition industries. That was quite a mouthful, but you can see here that Brookfield essentially invests in the backbone of the global economy. And this is what the company has done for over 100 years, and it's what it continues to do. In BAM's most recent investor presentation, it also says that institutional investors are allocating more of their capital to alternative assets. Alternative assets AUM has grown from $4 trillion in 2010 to $16.3 trillion in 2023, which is growth of about 300% within 13 years. Alternative AUM is also projected to reach $24.5 trillion by 2028, which is a growth of about 50% from the 2023 level. So institutional investors are moving a lot of their capital into alternatives, and it looks like this trend is only continuing. Now, what does this mean for Brookfield? Well, they have grown their fee-bearing capital from $129 billion in 2018 to $459 billion today. And the company is expecting to grow its fee-bearing capital to over $1 trillion by 2028, which does mean that Brookfield is expecting to more than double its fee-bearing capital over the next 5 years. Its fee-related earnings have also more than doubled since 2018, and they are projected to more than double by 2028. So the company is very much so projecting to about double its business over the next 5 years. This next slide shows us some key highlights from Brookfield Asset Management. And here we can see that it does have a net margin of 55 to 60%, which means that it is a very, very profitable business. It is also projecting growth of about 15 to 20% annually, and it pays out 90% of its earnings as a dividend to its shareholders. So if earnings are projected to grow by 15% annually, then BAM should increase its dividend in line with the earnings growth, which should be 15% annually. This also means that BAM is a stock that offers a 4% dividend yield today and is projecting to grow its dividend by roughly 15% annually over the next 5 years. This combination of a high dividend yield on cost plus high dividend growth is something I haven't seen in the markets before. And this is why Brookfield Asset Management is one of my largest positions and why I have continued to say that I do believe it is one of the best dividend stocks in the entire market. Now, to finish this up, Brookfield Asset Management also has no debt on its balance sheet. And in addition to having no debt, Brookfield also says that it has roughly $3 billion of cash on the balance sheet as well. So the balance sheet is very strong with $3 billion of cash and no debt. So now let's head back over to Stock Unlock. And we can see that Brookfield Asset Management has a market cap of $14.82 billion today. So if we go 14,820 and we divide this by the $586 million of earnings in the trailing 12 months, we get a price to earnings ratio of roughly 25.29, which I do actually think is pretty fair for this business. However, if we go 14,820 and then we subtract the $3 billion of cash on the balance sheet since the company has no debt, then we get an enterprise value of roughly $12 billion. Now, if we divide this number by $586 million in trailing 12 months earnings, then we get an enterprise value to earnings of only 20 for this business, which I do think is a pretty attractive price for a business with such high margins that is also projected to grow its earnings by 15% annually. And for these reasons, I do think that Brookfield Asset Management is actually looking quite cheap in the market today. Now, additionally, if we head over to our DCF calculator right here, and we project Brookfield's earnings over the next 5 years at a 15% annual growth rate, with 15% annual growth to the dividend as well, and a 25 price to earnings ratio, then we get a compounded annual growth rate to the stock of about 15.2% and a fair value of about $65 per share, or about 26% above where the stock is currently trading. So if Brookfield can hit the low end of its growth guidance for the next 5 years and maintain a 25 price to earnings ratio, then the stock can deliver market-beating returns and pretty solid returns for its shareholders going forward. Now, additionally, if Brookfield can actually grow its dividend at a rate of 15% annually over the next 5 years, then it means that the dividend yield on cost of shares purchased today should be over 8% by 2028, which I do think is a very high dividend yield on cost for a business growing 15% annually. And again, this is kind of why I think that Brookfield is one of the best dividend growth stocks in the stock market. All right, moving on to the fourth stock in this video. This one is ATD.to, or Alimentation Couche-Tard. This is one of the largest convenience store companies in the world, and its historical performance has been absolutely incredible. If we take a look at Alimentation's performance since 1984, the stock is now up a whopping 206,000%, which is absolutely insane. The company also reports its earnings next week, so I am either going to look very smart or very dumb for putting this stock in this video. Alimentation currently has a network of 16,715 convenience store locations around the world. 7,100 are in the United States, 2,000 are in Canada, 5.2 thousand are in Europe, and 2,000 are international. And actually, when I went to Bali, I saw Circle K's everywhere, which is Alimentation's international brand. Now, what's also interesting is convenience store revenues are projected to grow in the US, Canada, and Europe by around 3% annually to 2027. Now, this is not a ton of growth, but it is a tailwind for Alimentation's overall business. And I do believe that the company will outperform these overall metrics that we are seeing right here. From 2005 to 2022, convenience store sales also compounded at 4.2% annually. They also grew through the Great Recession and through COVID. So the convenience store industry seems to be quite resilient and a recession-proof industry. Now, this next slide from Alimentation's most recent investor presentation shows that the US market in particular is quite fragmented. There's a total of about 150,000 convenience stores as of 2022. And 60% of those are single owner operated or independent convenience stores. So there is a ton of room for continued consolidation within this industry, even just in the United States. Historically, alimentation has grown through mergers and acquisitions as well. Here they say that 73% of its current network was acquired. They also have $10 billion in cash capacity for acquisitions today, so they do have the capacity to do some pretty large acquisitions if they find something attractive. Alimentation has historically targeted 11 to 15% return on invested capital on these acquisitions as well, which are pretty solid returns. ATD is also the number 2 leader in the United States, even though the company only has 5% of the total stores, which once again does suggest that there is a large amount of expansion and acquisition still to be done in the United States. The Latin America and Southeast Asia markets are also presenting opportunities, and alimentation is actively expanding in those regions. They're also looking to expand in Europe more and might do another large acquisition over there to enter some new markets and countries. So you can see that ATD is optimistic that it will be able to continue growing internationally through acquisitions. What's also interesting is that since 2004, ATD has completed 73 deals, adding 11,000 stores globally. So they have a long history of large acquisitions that end up creating immense shareholder value. This next slide shows us Alimentation's historical debt levels, and here we can see that typically ATD does take on debt to afford these large acquisitions. However, it then uses its cash flows to deleverage its balance sheet quite rapidly. And we can see that currently, the business does have a low amount of debt relative to its historical averages, which does suggest that it can afford more larger acquisitions right now. Now, when I talk to people about alimentation, they seem to think that this is just a gas station and convenience store company, but it is moving into the electric vehicle charging industry as well. In fact, its locations with electric vehicle chargers see 8% more foot traffic, 11% more visits, 6% more active customers, 15% more merchandise revenue, 12% more car washes, and a total of 20% more in gross profits. So ATD's electric vehicle locations are actually more profitable, and it seems like electric vehicle owners get more car washes and actually buy more merchandise. Now, if we take a look at Alimentation's price to EBITDA over the past decade, we can see that its average has been about 9.18, and currently the company is trading for a price to EBITDA of 9.35, so it is slightly above its historical averages right now. However, if we head over to Stock Unlock's DCF calculator and we project out Alimentation's EBITDA growth over the next 5 years, at 11.7%, which is the company's own internal metrics and projections that they provided to investors, and they repurchased around 3% of their shares annually, which is their 5-year historical average buyback rate, and they grow the dividend to 22% annually, and lastly trade for a 9 price to EBITDA ratio, which we did see was its 10-year average, then we get a compounded annual growth rate to the stock of around 14.5% and a fair value of around $96 today. So basically, if Alimentation can actually meet its own projections and grow EBITDA by 11.7% annually, continue buying back shares, and trade for its historical average price to EBITDA ratio, then the stock can deliver some market-beating returns going forward, and some pretty solid returns for its shareholders. And for this reason, I do believe that Alimentation is arguably looking quite attractive in the market today, and potentially even quite cheap. And that is why it is the 4th stock that I wanted to talk about in this video. Alright, but now let's move on to the 5th and final stock that I want to discuss. And this one is Granite Real Estate Investment Trust, with the ticker symbol GRT.UN.TO. Granite REIT is a Canadian-based real estate investment trust engaged in the acquisition, development, ownership, and management of logistics warehouses and industrial properties in North America and Europe. The company's portfolio consists of 143 investment properties, representing approximately 63 million square feet of total leasable area. The company says that it leverages its industry expertise to strive and maximize total returns for its shareholders and generate stable and growing cash flows. They also say that in executing the company's long-term strategy, they continue to expand their business by focusing on the following core principles: owning and developing institutional quality real estate, conservative capital ratios, proactive management, strategic allocation of capital, and strong corporate governance and unit holder alignment. And in my opinion, this is Canada's best industrial REIT, and arguably, this is Canada's best REIT as well. Now, if we take a look at Rexer's portfolio, we can see that it is globally diversified. They have 38 properties in Canada, 66 properties in the United States, 16 properties in the Netherlands, 14 properties in Germany, and 9 properties in Austria. So they are not just located in Canada, and their portfolio of industrial real estate is diversified throughout the world. Now, what's interesting to me is Granite Real Estate is down roughly 38% from its all-time highs. However, if we go and take a look at the company's revenue, we can say that it is currently hitting an all-time high, and as of the most recent quarter, it has produced $530 million in trailing 12 months revenue. If we also take a look at the operating income, it is currently hitting an all-time high as well of $405 million in the past year. Now, lastly, if we head over to the cash flow statement, we can see that operating cash flows have continued to grow, and they are currently at an all-time high of $313 million as well. So Granite's stock is down roughly 38% from its all-time highs, but its underlying fundamentals seem like they are continuing to grow quite well. If we take a look at Granite's price to operating cash flow over the past 8 years, we can see the average is about 17.1, and currently the company is trading for a price to operating cash flow of only 13.7. So it is trading quite a bit below its historical average price to operating cash flow ratio. Additionally, in the stock market crash of 2020, the company was trading for a price to operating cash flow of 13.7, which is what the stock is currently trading for. So this is the price ratio that the stock saw during the stock market crash of 2020, which could suggest that the market is currently being quite bearish towards this business. Now, if we also take a look at its price to operating income, its historical average has been about 14.8, and currently it is trading for about 10.6 today. This is well below the company's historical averages. And during the stock market crash of 2020, it did get down to a price to operating income of 12.2. So in terms of this company's operating income, it's actually trading below where it was during the stock market crash of 2020. And again, this business's revenue, operating income, and cash flows are all at record highs and continuing to grow. Now, what's also interesting is insiders have been buying a lot of shares of Granite over the past year. And here we can see that there has been a lot more buying activity than selling activity. And one thing I also like is the CEO of Granite is consistently buying more shares of the business. And right here, for example, he had a $2 million buy at $83 per share. And the stock is quite a bit below where this purchase was now. So I do like to see that insiders are continuing to buy more shares and increase their position in the business as the stock has come down and they are increasing their overall ownership. That is something that I do like to see from the management and the people actually running the company. Now, if we take a look at Granite's 2024 outlook, we can see that they are expecting adjusted funds from operation of $5.30 to $5.45. Now, the math on this works to about 6% funds from operations per share growth in 2024. So Granite is still projecting the business to see around 6% growth this year, and again, the company is selling for low price ratios, and I think that this is just because real estate is out of favor in the market right now. With higher interest rates and people more concerned that tenants will not be able to afford the higher interest rate payments, and overall vacancy may go up in the real estate industry. However, Canada has already started to lower our interest rates, and I do think that lower interest rates around the world will re-accelerate growth for real estate and for Granite as well. So this one is a pretty interesting stock that is now offering an over 5% dividend yield, while the underlying business does continue to grow, insiders continue to buy more shares, and the stock is trading well below its historical average price ratios. And again, personally, I do think that this is the best real estate investment trust in Canada, and for all of those reasons, this is the 5th stock that I wanted to add to this video. But with all that being said, that is going to wrap up the video for today, everyone. And if you did enjoy this video or you found it helpful in some way, then please remember to leave a like on it, as it does really help out my channel. Also, thank you again to Moomoo for sponsoring today's video. It is sponsors like this that really allow me to continue making content like this for all of you. And if you do want to go and check out Moomoo, then there will be a link at the top of my description. But with all that being said, thank you all again so much for watching, and I really hope to see you all again in my next video.